what's going on right now is the regulators and the banks are trying to understand where they have exposure, not just the banks impacted, but the other banks, the other regional banks, the other larger banks, local banks, smaller banks, community banks, and other financial institutions, private equity, hedge funds, asset managers, et cetera, localities, municipalities. And they're trying to understand what's my exposure and what are my rights? What can I do outside of withdrawing money? But there's money outstanding all over the place, and the regulators don't have that line of sight. And the way they've gotten line of sight in the past is they required it. And immediately what they're going to be doing in the short term is really just understanding from these types of banks and financial institutions more broadly, what's your exposure? What's in your, what are your rights? Or what do you think your rights are? Meaning what's in your contracts? And what's in your contracts is likely to be one of the biggest responses out of this, is for the banks to really understand their exposure and their rights to that exposure, the collateral related to that exposure, and the contracts around those different pieces, whether it's assignability, termination, eligible collateral, valuation percentages, just the parties, and understanding how the banks are interacting with each other, because it's usually not one focal point, it's usually many focal points that they're interacting. And those multiple focal points, those multiple areas of interaction have contracts, and they have rights and termination rights. And the reality is that most banks, especially tier 2 banks, and tier 3 banks and other financial institutions, don't have line of sight over their contracts of what's in them and what they can do. And separately, what kind of exposure, outstanding monies, balances, funds they have amongst each other. And those will be the types of questions the regulators will be asking, aside from other inquiries around it.